Okay, welcome back. Thank you for bearing with us as we changed over to the first panel. Everyone is now up on stage, I'm happy to say, and so far the technology is working well for us. So this session we have six speakers and a real range of experts from different backgrounds in this area. So we'll need to run this session reasonably tightly. We have three presenters providing their analysis of the revenue redistribution implications of different proposals, and three speakers responding to that from their different academic and policy analysis. So I'll introduce all six and then ask the first to start speaking. So our first speaker will be David Bradbury, who is the head of the Tax Policy and Statistics Division at the OECD, and who leads the team that have been doing so much of the work on this, including particularly the economic assessment. Now, as David and others will know, we at Tax Justice Network have been quite critical of the lack of public analysis and indeed public data to work with for this. So we're really delighted that that David will be presenting the OECD's analysis to us, and that we can then discuss the implications of that. The second speaker will be Ruud de Mooy of the IMF's Fiscal Affairs Department. And Ruud's been doing a lot of the FAD's work exactly on analysing the revenue implications of different approaches, different changes to the international tax rules, including formulary apportionment, but also residual profit allocations. Then Valpy Fitzgerald of Oxford University, and also a member of ICRIT, the Independent Commission for the Reform of International Corporate Taxation, will present the results of analysis that he and I and Tommaso Faccio have worked on together, using the public data on US multinationals, country-by-country reporting, to provide some analysis of the revenue distribution. Then the three speakers who will really take a critical lens to look at those three papers are first Kim Klausing, who's a professor of economics at Reed College, and has just published a book I am looking forward to reading over Christmas called Open, and is an expert on international trade and international taxation. Now, Kim herself has done some of the leading studies over the last 10 years of the revenue redistribution implications of potential international tax reforms. So we'll have a critical academic analysis of the work that's being presented. Then Abdul Chowdhury from the South Centre, who previously served in India's Ministry of External Affairs, and also back in 2016 was the winner of an Oxfam and Tax Justice Network essay prize for an essay on tax justice and human rights. Abdul will give a view from the South Centre of the different reform options and the revenue implications, and how that looks from the perspective of the South Centre. And last but not least, Laurie Feiner from Finland, who's been working up until today, but now no longer, as the Finnish government is in transition, as a special advisor in the Ministry of Finance. Laurie is also a long-standing researcher on tax justice issues, and has often presented at our conferences, finishing a thesis on the international tax regime. So we really are very lucky to have such a range of experts presenting, and I think, in the interest of time, we'll go straight into it. Let me just remind you the hashtag for social media is Global Tax Rights, and please do enter your questions for the presenters and vote on other people's questions in the box at the bottom of your screen. Okay, but now let me ask David Bradbury from the OECD to present, and please, David, to share your screen so we can see your slides.
Well, thanks very much, Alex, and I hope I can get the technology working from my end. Hopefully you can all see a set of slides now, but it's a great pleasure to be with you, and I want to take the opportunity to commend you on the virtual conference, which clearly this is moving into uncharted territory to some extent, and when we talk about the tax challenges arising from the digitalisation of the economy, it's living proof of the impact that these changes are having. Now, I will try and move reasonably quickly through the presentation that I have. I'm having a little bit of difficulty moving slides, but here we go. And try and give you a little bit of a flavour of the work that we're carrying out for the inclusive framework. Now, you will recall that the program of work, which was adopted by the inclusive framework back in May, outlined a number of things. Firstly, it outlined the two pillars of work that the inclusive framework is undertaking, but it also indicated that there would be an economic impact assessment being undertaken by the Secretariat. And the purpose of that, of course, is to inform the ongoing deliberations of the members of the inclusive framework, which at this point is now 136 jurisdictions. So as this slide indicates, it provides a little detail on the two pillars. I won't focus too much on that because I'm assuming that we all have a reasonably good understanding of what's at stake, but certainly Pillar 1, which is focused on the allocation of taxing rights. There was, at the time of the program of work, a number of different proposals that were on the table, but I think most of you would be aware that on the 9th of October, we released a Secretariat proposal that is being described as the unified approach. And the unified approach is really the bringing together of the various elements of those three proposals that were on the table earlier in the year. And it is currently the principal focus of the work on Pillar 1. And Pillar 2, of course, deals with what might be described as remaining BEPS issues in the form of a global anti-base erosion measure. Now, the focus of this presentation, in keeping with the theme of the conference, will be on revenue implications. But I should say from the outset that we are doing work on the investment implications and the broader implications of the proposals on the global economy. I should say that in terms of the work that we're doing, because we are modelling and undertaking the analysis in parallel with the ongoing technical and political discussions, we have developed a fairly flexible analytical framework, and that is to ensure that we have the ability to continue to model refinements in proposals as they occur. The analysis itself draws upon both broad geographic and company coverage, more than 200 jurisdictions, more than 27,000 M&E groups. We have developed for countries a revenue estimation tool that they are currently using, and that is something that is focused on what should be described as Amount A of Pillar 1. Now, in terms of the main caveats, and there are a number of important caveats to make, the estimates are static, although we are currently carrying out some work on Pillar 2 that will take behavioural responses into account. Many of the reform parameters and the design features continue to be the subject of discussion, so that's a limitation of what we can say at this point. The data itself, there are considerable limitations, and I'll talk a little bit about some of the data sources that are being used, and Alex referred to some of them a little earlier. The underlying data on profit and the location of profit comes from the year 2016, and now that is the most recent that we've been able to compile on a comparative basis. But of course, that doesn't take into account some important recent events, such as, for example, the US tax reform, and that is an important limitation as well. And we continue to work very closely with all of our member jurisdictions, the 136, in order to refine the quality of the data that is underpinning this analysis. And against the backdrop of those caveats, the results that we are producing for jurisdictions need to be interpreted as broad orders of magnitude rather than precise point estimates. Now, in terms of Pillar 1, the key objective really has been to provide initial results to allow jurisdictions to gauge the overall direction and magnitude of the impact of the proposals. Now, we have developed that in a way that takes into account a range of different design and parameter scenarios, and that has allowed jurisdictions to test different options as they have the discussions around the design of the proposals. We've done that not to prejudge, to ensure that there's no prejudging of some of those key decisions that have not yet been taken by the inclusive framework. And of course, it's important to note that this analysis occurs against the counterfactual of what we are seeing today, and no doubt would continue to see with a further proliferation of unilateral measures and all of the uncertainty and the ongoing tax planning from MNEs that would occur against that backdrop. I mentioned the coverage, and I've also mentioned many of the caveats. So what are we seeking to do, and how are we going about this? Now, what I present on this slide is very much a simplified illustration of the type of analysis that we are undertaking when we're seeking to assess amount A of Pillar 1. And just to quickly refresh, amount A is determine a share, or firstly you determine what residual versus routine profit might be. To the extent that there are residual profits of the M&E group, a share of those profits will be allocated to market jurisdictions and taxed in those jurisdictions. Now, the simplified equation that I present here shows what the tax revenue change for a particular country might be. And we have to firstly determine the global residual profit that is the subject of allocation, and that involves that first step and the second step of determining the share of that profit. We then, and we use a number of important data sources that I refer to on the slide there. Then we multiply that by essentially the difference between the particular country's share of multinational enterprise sales and their share of residual profit. Now, whereas the initial estimation of global residual profit can rely upon consolidated account financial information, the location of residual profits is not visible within those accounts, so we have to look to other sources. And then, of course, you need to take into account the tax rates, the relevant tax rates, both in terms of the market to which the newly allocated profit is to be attributed, and also in taking into account any double tax relief that would otherwise need to occur. Now, a summary of the main insights so far. We see a modest global net tax revenue gain as a result of Pillar 1. We see that low and middle income economies tend to gain more than advanced economies. And that's largely driven by the fact that they have a smaller share of residual profits located in their jurisdictions. It does suggest that on balance they gain in tax base, and they also typically will have higher statutory CIT rates, the rate at which that new tax base will be subject. Now, these results do to some extent depend upon a key element of design around whether or not commodities and extractives are to be carved out or beyond the scope of the measure. And I think it's fair to say that there is very strong support for extractives to be beyond the scope of the measure. But what we do see is that investment hubs, and we define investment hubs for the purposes of this study as those jurisdictions that have FDI at 150% or more, we find that investment hubs tend to experience significant losses in tax base. Now, I just heard a little bit of music there in the background. I'm not sure if it was just me, but perhaps someone was welcoming that particular finding. I'm not sure. In terms of the multinational groups that are likely to be affected, we see strong concentrations of digital-oriented and intangible-intensive businesses being affected by this measure. Now, in terms of the revenue estimation tool, I mentioned this a little bit earlier. We've developed this. It is customised to individual jurisdictions. It was shared with them. We've taken them through a demonstration on how to use it, and there's ongoing bilateral engagement with them. Firstly, to ensure that they understand how to properly use it for their own policy-making purposes, but also to ensure that the underlying data sources, they have the opportunity to comment and to verify to the extent that they can that data. And that bilateral engagement has also extended to the methodology that underpins the analysis as well. And we will continue to refine the results based on the ongoing discussions around data quality. Now, in terms of Pillar 2, to just move to some of the main insights, the global net tax revenue gains of Pillar 2 are expected to be significantly higher than those under Pillar 1. But of course, that will depend upon design considerations. Of course, both the extent to which we have blending and indeed the rate of that tax will be significant. In terms of the distribution of gains across countries, this very much will depend upon the multinational enterprise and government behavioural responses, and we're currently modelling a range of scenarios that reflect different potential responses that we might expect to occur in the context of these reforms. The additional tax burden from Pillar 2 is likely to fall on similar types of businesses as what we referred to in Pillar 1, digital-oriented, but we also see financial and real estate sectors in play here as well. Pillar 2, and I think the same could also be said for Pillar 1, will act to reduce countries' incentives to offer tax incentives, and particularly those that result in windfall gains. Pillar 2 should also level the playing field for countries, particularly those countries that may feel under pressure to provide these tax incentives in order to compete with other potential investment locations. Just on the behavioural responses, a couple of quick observations to make. We believe that multinationals will react to changes under Pillar 2, that a reduction in tax rate differentials as a result of this measure is likely to reduce incentives to engage in profit shifting. The revenue gains are also expected to be larger in jurisdictions with effective tax rates that are above the minimum tax rate, particularly those that are just above the minimum tax rate. In terms of governments, well, there'll potentially be a range of government responses. We would estimate that and anticipate that jurisdictions with low or zero tax statutory tax rates may increase their rates, may soak up to the minimum. But we also expect that some jurisdictions may increase their effective tax rates by curtailing a range of tax provisions that are currently available in order to ensure that that benefit of the minimum tax is not absorbed by some other jurisdiction. And we would also anticipate stronger use of some anti-avoidance measures to buttress or to support that effort. And then, of course, there are the real investment decisions that may be driven by non-tax factors, and in the longer term, we would expect that if you reduce the tax rate differentials, that it is likely that some non-tax factors or some non-CIT factors are likely to play an even more prominent role in determining investment decisions. Now, just to conclude, a couple of comments about overall key messages and then next steps. The combined revenue impacts of Pillars 1 and 2 would lead to a significant increase in global tax revenues, as well as a redistribution of taxing rights, with an emphasis on increasing taxing rights in market jurisdictions. Pillar 2 would have a larger impact on global tax revenues than Pillar 1, and we are currently modelling the interactions between the two. Tax revenue gains accrue to most jurisdictions, the only exceptions being investment hubs. There are complementarities between the two pillars. We see that in terms of the sectors and the firms that are likely to be affected, but there are some differences as well. And the reform of both Pillars 1 and Pillar 2, we believe, will strengthen the impact of real economic factors on the scale and location of investment decisions. Now, what does this mean for developing countries? A few highlights. Developing countries tend to gain from Pillar 1. Their share of global sales is higher than their share of global residual profit, the latter being the most significant of the two considerations. The commodities carve-out is important. Amount B, which we haven't talked about much in this presentation, but it is likely to be of greater benefit to developing countries. And developing countries generally tend to rely more on corporate income tax revenues than many advanced economies. So in that sense, increased CIT revenues do represent a larger gain in terms of the proportion of their total tax base. Developing countries tend to be more affected by BEPS. There's considerable literature to that effect, and therefore, to the extent that these measures do reduce incentives to engage in profit shifting, that will be beneficial to developing countries. And then there's the tax incentive story, particularly in terms of the work that has been done in the past on inefficient and ineffective tax incentives. Sometimes there's a prevalence of them in developing countries, and hopefully Pillar 2 in particular will help relieve some of the pressure in that regard. It's even though the economic analysis is not absolutely precise because of the range of caveats and limitations that I referred to earlier, it is worth noting that some of these issues are exacerbated by the paucity of data that we sometimes encounter in developing countries. But notwithstanding that, we have been seeking to present the best possible picture in the circumstances. And just finally, where do we go from here? We are refining results as important decisions around parameters, scope, and the operation of the unified approach occur. We are undertaking more consideration of how we might be able to model some of the impacts of Amount B. That's much more difficult because it really does rely on transaction-based data. And in terms of Pillar 2, we are, as I mentioned earlier, incorporating different scenarios around the behavioural responses. We will be, in the same way as we have done for Pillar 1, developing a jurisdiction-specific revenue estimation tool to provide results to countries. And we will refine as the key decisions are taken around the design of Pillar 2. And also, there's the interactions between Pillars 1 and 2, the ongoing work on investment impacts, which I have not focused on in this presentation because I think the emphasis here in the theme of today's conference is really on revenue, but would be happy to talk a little bit more in the Q&A if that's of interest. And the goal is to release some of the elements of the economic analysis in early 2020. And given that the project's time horizon is to try and seek a consensus-based solution next year in 2020, we will be working towards making more and more of our results publicly available in the first quarter, and then some further results in the first half of 2020. And that's it from me.
Thanks very much, David. We really appreciate having the kind of the headline findings of the work you're doing laid out. I'm sure there will be a lot of questions, but we'll come to that at the end. So let me move on to Ruud right now to guide us through the findings of the work that the IMF have been doing on this. Ruud, if you're...
Hey, thank you very much, Alex. So I'm getting my slides up. Hopefully they show up. So thank you very much, and good morning, everyone, or good afternoon for some, and for good early morning for Kim. So what I would like to do is reflect on two pieces of work that we did at the IMF on formulary methods in international taxation, which builds...
I should just say your slides haven't appeared yet.
They have not appeared? Okay, let me... Should I try again, or?
Yeah. I think if you
try share again. Share.
Yeah, we can see your desktop and PowerPoint opening.
So this is better?
Yeah.
Right.
Perfect.
Okay. So what I would like to do is reflect on two pieces of work that we've done, which built on the IMF paper from March 2019 on first on formula apportionment, an assessment of global formula apportionment, and then also some follow-up work we did on the residual profit allocation. And I'll be brief on both, but to give you some highlights of the analysis. So on formula apportionment, basically what we have done is we exploited three different data sets to assess the revenue implications of global formula apportionment. First of all, there was the Orbis data set, which is firm level data, primarily for European companies. And firm level data is important if you want to understand the implications of the consolidation of losses and what this means for the global tax base. And I'll reflect a little bit on that in a second. The second database we use is the Bureau of Economic Analysis, which is for US multinationals. That's not the microdata, but that is aggregate data for the US multinationals operating abroad. And the attraction of that database is that it allows for the analysis of many more formulas for the allocation of global profits. And the third database that we utilize is from the Internal Revenue Service in the US, the country-by-country reports, which were recently released, again, which are aggregate data. And the attraction of that database is that it allows for the analysis of many more countries compared, for instance, to the Bureau of Economic Analysis data. So each has its own comparative advantages. And together, I think it gives us a picture of the revenue impact of global formula apportionment. Essentially, what we do with the data is we, first of all, take a measure of profits as a reflection of the tax base currently under the current rules allocated in countries. And we compare that with a simulation whereby we say we first consolidate all these profits of the multinational, and then we apportion that consolidated profit according to different formulas. So we compare these two sort of amounts of the tax base, and we multiply that with the same tax rate. But that gives us an idea of the change in revenue, the static change in revenue, so excluding any behavioral change on different countries. What we also do in the paper, and I'll pay some attention to that, put us in a wider context, but I'll get back to that in a second. First, something about the results. First, on what it means for the global revenue if we move to global formula apportionment. And this is determined by two different effects. First is the effect of loss consolidation, and that's the upper part of the slide here. And second, there is the reallocation of the tax base among countries. And if the tax base is reallocated from low tax to high tax countries, you can expect an increase in global revenue. So that's the lower part here. So the upper part, essentially, I'm not going to discuss all the aspects of the figure, but it essentially shows the stock of loss carry forwards under a system of separate accounting and a system of formula apportionment. And you see that the stock of losses carried forward is much larger under separate accounting because losses cannot be offset between loss-making affiliates and profit-making affiliates, which is possible under consolidation and formula apportionment. So therefore, the stock is much smaller in the right picture here. The blue line is much lower. And this essentially means that the overall tax base, because of loss consolidation, will be smaller under consolidation. And the Orbis data allow us to put a number on how much it will be smaller, and that is about 10% smaller, which is sort of in line with what previous analysis have found, also using microdata for the impact of consolidation. So that's the one effect. But then there is the other effect of the reallocation of the tax base from possibly low tax to high tax countries, which would increase tax revenue. And the picture at the bottom shows this for the three data sets. So there's Orbis on the left, there's the BEA in the middle, and there's the IRS on the right. And it shows it for different formulas. So we have assets and employment formula for Orbis and the IRS, and we have 7 formulas for the BEA data. For Orbis, we find there's some increase in revenue because of this effect, but it's less than 5%. So it's not enough to offset the impact of loss consolidation. But with the BEA data, for which we cannot look at loss consolidation because these are aggregate data, the increase in revenue is actually much larger. It's between 5 and 15%, depending on the formula. And for the IRS data, there's a mixed results for the different formulas. But the punchline for the impact on global revenue is that there's these two effects, and the balance of these effects is not entirely clear whether the global revenue will increase or decrease because of the impact of loss consolidation. Now, the second, I think, interesting finding from the analysis is with respect to the impact for country revenues. So which countries gain and lose? So this gives a high-level picture of the impact, according to the analysis, for a number of countries. And first of all, what struck me in looking at the individual country numbers is that the impacts are very large for a number of countries. So moving from the current system to a system whereby we allocate the profit based on production factors or sales gives a very different picture on the tax base and the revenue. So essentially, this means that the current allocation does not reflect an allocation that is based on where the production factors are based or where the sales take place. These are very big changes. Second, what is also striking is that the effects are quite diverse for individual countries. If we look at, for instance, different data sets, sometimes a country loses in one data set but gains in another, which might have to do with differences between European and US multinationals. But it was quite striking that there's no, for many countries, there's no sort of uniform picture that formula apportionment is always good or bad. Depends on the data set, and it depends also very much on the formulas that are chosen for the formula. So we have assets, sales, payroll, and so on. For individual countries, it matters a lot what is the exact choice. And this is also reflected in the picture above, which shows the median effects of moving to formula apportionment for OECD and for non-OECD countries. So these are percentage changes for the companies that are analyzed in the data set here. And what you see is that with the Orbis data, on the median OECD country loses, which is reflecting the impact of loss consolidation, which is included in the analysis with Orbis. Under the BA data, however, the median OECD country always gains under all the formulas. And the picture is mixed again under the IRS. For non-OECD countries, so which reflects more the impact on developing countries, the picture is more mixed compared to OECD. There's, for instance, decreases under the payroll formula and the asset formula, always. But there's always an increase under the employment formula. So this is clearly something to keep in mind if you want to reflect the interest of developing countries. The choice of the formula is really important here. What is also interesting is the sales factor. We find for the sales factor under the BEA data, where we come closest to measuring sales by destination, an increase in revenue for the developing countries. It's a small increase, much smaller than under the employment factor, but clearly an increase. The picture on the bottom reflects the impacts of, as David also analyzed, what we call investment hubs, here defined as the countries with the highest foreign direct investment to GDP ratio in the data set. So it's sort of the similar group of countries that David analyzed. And we also find that these are the countries where we observe big losses in revenue. So compared to the current allocation of profits, an allocation based on where production factors are based or sales is based, these countries would lose significantly. I think these sort of systematic effects are quite interesting from the analysis. But I think it's also, we need to warn against this type of analysis, because this is simply using data, using some accounting to assess the revenue redistribution if we move to such a system. But if we want to really think about a system of formula apportionment, it's probably going to be a system that is much more granular than we have analyzed with these data. If we look, for instance, at federal states that use formula apportionment, they are much more granular. They're not always applied to all the profits of all the companies, right? So it's in the Canada, for instance, it is applied to branches and not to subsidiaries. In the US, they make a distinction between business and non-business income and so on. Countries also use specific formula for specific sectors, the financial sector, but also the extractives or transportation sectors. So once you start to really design a system of formula apportionment, these more granular aspects come into play and also matter, of course, for the outcomes. What is also interesting is that factors are usually source or destination factors. But in China, for instance, they also use a factor that is related to residents. So that's where the headquarters is based. They also, in these provinces, they also receive a portion of the profit. So that includes also residence factors in the allocation formula. The second point I want to make is the dynamic effects that David also pointed to, which can be very important. And some analysis has shown that if you include sort of responses by investors to formula apportionment, for instance, if you take assets in the formula, this can really change the results. And of course, this requires many more assumptions in the analysis, but I think realizing that these dynamic effects can be important matters a lot. Also, in terms of sales by destination, the question is, how manipulable are sales by destination? Can we sort of expect sales hubs to exist, because with very low tax rates, that all the sales take place from such low tax sales hubs? What will be the impact on tax competition? So these are all important considerations for this discussion. Then briefly about residual profit allocation. The idea to split the multinationals' profits into a routine return and a residual return, and doing the routine by some sort of arm's length methods, and the residual by formula apportionment. That's sort of a hybrid system between the current system and formula apportionment. Here we did some analysis using macro data. Basically what we did is we took information about the capital stocks of countries, so the private capital stock of countries, and then said, well, let's assume that there is a routine return on that private capital stock of 7.5%. And we allocate that to the countries where the capital stock is based. Then all the residual profit, so the profit on top of that is the residual, that we allocate based on sales by destination. And for that, we use GDP minus net exports. So this is the exercise that we did to get a grips on sort of what could be the possible revenue implications for individual countries. And the picture here shows these revenue impacts. Again, very large and very diverse. But I think it's more interesting to look at sort of systematic patterns in what drives the revenue impact for the individual countries. What we here find is that revenue impacts tend to be more positive for countries with higher CIT rates, also for countries with lower incomes. So here you also see this dotted line, which is a regression line. So lower income countries tend to gain more than higher income countries. And also, if we include a dummy for investment hubs, this is clearly negative. So the investment hub tend to lose. If we do the regressions, we find insignificant effect for resource-rich countries, which was unexpected. The sign is appropriate, but it's not significantly different from zero. And also for the current account, we could not find systematic effects. We also, by the way, find a global gain because the tax base is redistributed from low tax to high tax countries here. Now, this was an analysis of residual profit split, and I want to emphasize also that this is somewhat different also from the unified approach that David just described. And so first of all, it is sort of more a broad-based analysis. It's not focusing on only large companies or consumer-facing businesses, also not taking a fraction. It uses all the residual profits. But also, I think the design is different because the purpose, as sort of described in the literature on residual profit splits, papers by Kim Clausing, by Auerbach, Devereux, and so on, the purpose is really to replace arm's length pricing where it is so difficult and so arbitrary. So the motivation is really to simplify the system and to eliminate the arbitrariness of arm's length pricing and replace it by residual profit split, whereby for the most difficult part of the profit, we allocate based on a formula rather than by arm's length pricing. And I think the motivation for the unified approach is much more the reallocation of profit. And what you therefore see is that it's not computing a routine return and then everything that's left is a residual, but rather it's a threshold, and then identify what are the excess profits, and then say, well, a portion of the excess profits are going to be reallocated. So it's not a sort of an approach to simplify, but more motivated by the desire to reallocate a portion of the profits. So it's I think it's important to understand these differences in interpreting the results from, for instance, an analysis of formula apportionment of residual profit split as described here, and in an analysis of the unified approach, which has many similarities, but also some important differences. And I would like to keep it at that.
Great, thank you, Ruud. That's a really great overview of all the research that's going on. Let me hand over to Valpy, if you're ready to go, Valpy, for the final set of results, and then we'll move into the set of responses. Valpy, you're muted, sorry.
Right. Can you hear me now?
Yes.
Okay. Can you see my slides? Yes?
No, we can still see.
What? Can you see my slides?
No.
No?
Can you try sharing your screen again?
I can try anything. Let's see.
It's the green button in the middle at the bottom.
Yeah, I know. I got my slides up. It says loading videos stream now. Share slides. Here we are. Is this working now?
Yes. Yes.
And now I see slides. Yes.
Perfect.
Yes.
Yes. Thank you.
Okay. Ready? Okay. Well, good afternoon. It's here. Afternoon in Spain. We're just finishing the olive harvest, which is why I'm dressed in peasant kit. So to start off, I would like to just mention a few general issues about estimation. The first one is that it's implicit in what has been said before, but I think it has to be made explicit, is that The global nature of multinationals means not only that the profits can be shifted between jurisdictions quite easily, as we've seen, but also the tax base cannot be attributed technically to any particular jurisdiction as a true source of profit, because much of the profit, particularly the excess profits of multinational, arises from their multinational nature. So a formula, in a sense, has to be arbitrary and negotiated. There's no correct or technically superior formula to any other. It is essentially a negotiated process. The problem is that the negotiation is inherently asymmetric, in the sense that although obviously there are clear global gains from tax coordination, and potentially every country participating, except obviously from the tax havens, could benefit, the formulae, as we've just seen in the IMF presentation, have enormously different impacts. Now, the differential impact arises not just from the data source or from the nature of the multinationals themselves, but also from the structure of the countries themselves. The most obvious one is whether it's a capital importer or a capital exporter will affect it a lot. Secondly, the productive structure of resources, whether it's a capital-intensive country or a labor-intensive country. Fairly obviously, the different formulas will give different results according to that underlying structure. And thirdly, the levels and patterns of consumption. If it's a major sales destination country, then it'll obviously benefit sales-based formula, and so on and so forth. So we have to recognize that the system is inherently asymmetric. Our own estimates, I'll come to in a moment, seems to indicate that the OECD consensus proposal we've just heard from appears to mean reassigning about $50 billion in taxing rights worldwide, mainly from the tax havens. But from our calculations, the main beneficiaries from this, about 80% of it, would actually be the high-income developed countries. And only about 10 billion would actually accrue to developing countries. But as we've seen from the IMF data, the database you use, the assumptions you make can affect these results enormously. So I'll try to explain what we've done. Before I start, I would like to underline the fact that this is a significant step forward, the OECD proposal, and the fact that negotiations have got so far and may well reach agreement in 2020 is enormously positive, because the principle that profits should be reallocated internationally is a major step forward. Our problem is, from the point of view of our Commission, that the likely extra revenue to developing countries, which we estimate to be in the order of 2 to 3 billion under the OECD unified proposal, consensus proposal, does seem to be very low and far lower than expectations. So I think we do need to have a much wider debate on alternative formulae and not just accept the OECD consensus proposal as the only one that is to be debated. Well, as Alex mentioned at the beginning, the Commission has undertaken some modelling work undertaken by Alex and Tommaso and myself, and here is the sort of the URL which you can check the data and so on later. We've actually considered a number of models, as the IMF did. We've looked at allocating the entire global tax base on global formulary apportionment. We've looked at sales alone, which would be equivalent to the destination-based sales tax, and also by allocating by employment. We've also looked at the OECD method as of using the existing BEPS allocations, and also the IMF method of assuming a fixed return on tangible assets. And finally, we've looked at the unified proposal where only 20% is reallocated. Now, we have not been able to get a good source of country-by-country reporting by companies worldwide. So this analysis is based on the US data for 2016, which we've then used to reassign the taxable base under each formula and then applied the statutory tax rate in each country to that. It should be remembered that the multinational profits reported by US multinationals are approximately a half or a third of global profits, and thus any figures that we're showing should be multiplied by 2 or 3 to get an order of magnitude. The first result, which is here now on the screen, is that the formula matters, that the percentage increase in current CIT revenue varies enormously according to the model. As we can see, the percentage increase from all the models is always positive for the high income developed countries. For the lower middle income countries, it depends a lot on the model. Sales and employment models tend to give a positive result. Ones based only on sales tend to give a negative result. This is again matches from what we've been looking at before. We've separated out tax havens, what the OECD and IMF euphemistically call investment hubs. Our definition is slightly different in that we've taken not the FDI to GDP ratio, but the degree of misalignment between economic activity and profits reported as the criterion. And last but not least, all the formulae do give an increase income to the upper middle income countries. That is what sometimes referred to as emerging markets. But the formula matters enormously. And as you can see, the OECD consensus model is the one that gives least benefits to developing countries. So there are 6 initial results from our modeling exercises. The first one is the absolute scale of benefits is potentially very large, even though not as large as it might be, as I indicated. Secondly, comparing the sales-only variance, the OECD model is the least beneficial for all groups. The IMF model, that is, of residual profits calculated on the IMF model, is preferable to that, and global formulary apportionment gives the best, basically because global formulary apportionment extracts the maximum amount from the tax havens for redistribution. Secondly, what is interesting is that a formula based on employment and sales benefits all groupings except for the US, which is the major beneficiary from a sales-owned apportionment method. Developing countries, as we know, benefit even more from an employment and sales model. So again, this is the sort of asymmetry I was mentioning in the introduction to my talk, that the economic structure of the country in question is what's affecting things, not just the formula or the data. The US does appear to be an outlier. We're not clear whether it's because it's the HQ country for the companies, US companies in our database, or whether it's because it's a major sales market. We await with interest the full country by country accounting data held by the OECD, which we hope will all be released in 2020. As to say, just releasing to each country the data for its own country doesn't seem to be enough. It seems to me that, up to us, that all the data available on all the countries should be released to all the countries participating in stage 1 and stage 2. This database should be made public so that independent assessments can be made of any results generated. As I've mentioned before, the upper middle income developing countries do seem to gain from most of the formulae, albeit less than developed countries do, and that lower middle income countries will lose their tax base, smaller if the apportionment is on a sales base. So there's quite a lot to be lost potentially. So I said these results seem to be consistent with the IMF results. Last but not least, the benefits from the latest 20% OECD proposal are very small, and again are regressively distributed to the advantage of developed countries. Now, the final point I wanted to come to is that about the principle of equity or fairness. One of the principles on which the whole G20 process was set up was that the resulting system should be not only improved, more efficient, and increased amount of tax revenue, but it also should be seen to be fair. Now, the canonical principles of taxation are ease and equity, ease being certainty, which certainly the new proposal increase global certainty on it, convenience in the sense that it would be easier to use, which would be a step forward, and also more efficient in the sense that, as the IMF was just explaining, the new tax system would not only generate more income, but it would reduce the distorting effects of the existing tax system. But we also have to take into account questions of equity or fairness. And this, it seems to me, has not really been debated properly. Now, we're talking about a taxable base that is now agreed to be global. So some principle of equity has to be introduced, both horizontal equity, that is fairness between countries, and vertical equity, that is between the different citizens of the world. The first step, it seems, that the vertical equity would mean looking at per capita gains to see whether the rich or the poor countries gain more per capita. And then we should also be asking our question about whether we desire the tax system to be progressive in the sense that it might benefit more the poorer countries who have a greater need for public services provision. So what we've done is to calculate the impact of the OECD 20% model in terms of increased income of dollars per capita to the different groups in the world. Well, as we pointed out, the gains are not very large, but it's very clear that the per capita gains to the US, particularly on the sales-only model of $8 per capita, are far, far larger than, for example, the gains to the G7 without the US, which is only about $4 per capita, or to the rest of the OECD without the US, which is only $2 per capita, or to the G24, which is below $1 per capita, or to the G77, which is also way below $1 per capita. Now, we're not suggesting a radical overhaul of the system, but we do ask questions about whether a tax proposal that the per capita gains to the US are 8 times those of the capital gains to the rest of the developed countries, to the rest of the world, double that of the rest of the OECD, and many times greater than that to members of the G24, can really be described as a fair system. So thank you for listening to this. Critical comments are welcome, but remember, this is a small-scale academic initiative. We don't have the resources that the OECD or the IMF has for modelling. I would like to repeat that I think it's a significant step forward, the OECD proposals, even if the impact is limited and skewed, as we've explained. We do feel strongly that work on the fiscal and equity implications for developing countries of a much wider range of options should properly be the responsibility of international institutions. And we're glad to see that the IMF is looking at a wide range of options. And we regret that the OECD has not published results for the full set of options as originally agreed. And last but not least, as I've explained, the asymmetry in access to information that presently reigns only serves to exacerbate the existing structural asymmetry in global tax negotiation. Thank you very much.
Thanks, Valpy. That's you'll be surprised to hear. I agree strongly with lots of that. Look, I realise I've allowed us to run slightly behind time, so we must. I should be more ruthless now. But we want to hear from the next 3 speakers, all of whom can offer, in different ways, very interesting insights onto the technical and policy aspects of the papers that have been presented so far. So allow me to turn to Kim Clausing, whose slides we can now see appearing in front of us. Kim, over to you.
Hi, thank you so much for having me. I think this virtual conference, despite the early start for me, is a really good idea, and it's a pleasure to hear from all of you. And just think of all the carbon we're saving by or the carbon we're not emitting by doing this virtually. So just at first, a couple really quick comments on the earlier presentations. I enjoyed hearing David describe the OECD work. I think one thing that's really clear from looking at that work is the sort of great value of having economic decisions be driven more by things that are not tax matters. And I think all of the work that the OECD has done in this area is really commendable. And I think using multiple data sets really does illustrate the potential for these sorts of efforts to help developing countries who do have such a reliance on corporate tax revenue. The IMF paper, I think, also really should be commended for this use of multiple data sets. And one of the things that I'm going to talk about is sort of the difficulty of coming up with clear conclusions without looking at the data a lot of different ways. I really liked the points there about the consolidation of losses, because that's an important issue to address. And one thing that we see already in the country-by-country data for the US is you get vastly different quantities of revenue depending on whether you're focusing on those companies that have positive profits or not. So that's a really important issue. And as we turn to a study of behavioral responses, I think one important thing for us all to keep in mind is that the literature in public economics makes quite clear that financial responses are almost always much, much larger than real responses of things like employment and assets. And that's one of the reasons why sort of moving in this direction of taxing based on real things rather than financial things has the chance of raising so much revenue. I also like the tax justice paper. I won't say as much about that because I think Alex knows that I've already sent him detailed comments on the paper, so I'm assuming that will get to the authors. But one thing that I think is true with all of this literature is it's kind of our guesses are only as good as the data. So looking at these data sources that I've listed here, I would caution, I guess, too much reliance on the Orbis or Compustat type accounting databases, because while you can look at company level information, which is great, as we heard, for considering things like loss consolidation, it does miss almost all of the haven income of major multinational companies, because you can't see the location of, for instance, Apple's profit. Like most of the foreign income isn't sort of recorded as being in havens. So it does raise this issue when researchers use that to make inferences about profit shifting or revenue, that they're getting really nice detail about company operations, but they're looking in the wrong place for the profit shifting, because without the havens, you're missing almost all of the story, which is one thing you do see in almost all of these data is the real nonlinearity of response to taxation, where there's a big response to the haven rates and much more modest response to differences between, say, a 20 and a 25% rate across countries. So the US Bureau of Economic Analysis has some really nice data that several of you have used in these analyses. I like to rely on the direct investment earnings series. And the nice advantage of that series is I think it includes most of the shifted income without any double counting issues. Recently, researchers have suggested that we instead rely on this method of using the net income series, which does have double counting, but subtracting the equity income. And as I'm going to show on the next slide, I think we do lose some of the foreign to foreign profit shifting there. So we may see, for instance, the shifting between the US and its affiliates, but we might miss the shifting from, say, a German affiliate of a US company and a Bermuda affiliate of a US company. And so that could lead to misleading inferences about how much income is in havens. And this sort of brings me to this sort of difficulty of really measuring where the foreign profit is taxed. And there's a nice recent paper that was just presented at the NTA by Dyring, Hills, and Markle that shows that this amount of U.S. multinational income that's untaxed anywhere is really growing and is reaching into, I think that their magnitude is 170 billion by 2017. And so if we're counting that income as having been taxed in, say, Germany, we're going to get a sort of a misleading perspective on that. Of course, there's tax data too, and there's country-by-country data, and I'll use some of the country-by-country data in just a second to sort of illustrate the range of findings we can find even with the U.S. data. So just two or three really quick data slides. This one shows the difference between the subtraction method, where you sort of subtract out the equity income, and the balance of payments data that use the direct investment income. And if you look at the totals are a little different, but also the haven share is very different. Neither of these series have any double counting in them, but where they're putting the profit really varies. And we get some puzzles when we just subtract out the equity income. For instance, Bermuda income is negative with that method, which seems odd because we know, based on even casual observation, that US companies are really excited about getting the income into Bermuda, where there's a zero tax rate. So it seems odd that the income would end up being negative. And if you go and compare, say, the Bermuda line across data sources, you'll see that the country by country data, which should also be immune from having profit shifting, show tens of billions of income in Bermuda, and in fact, hundreds of billions of accumulated earnings, which is that final column. So this is just sort of a caution that kind of which data source you use really matters. If you look at sort of the haven share of income in those bottom rows, it really does differ substantially. And that's really the income that you're handing back to countries when you do these formula apportionment calculations. So knowing how much there is to hand back it is, I think, an important part of really understanding the magnitude of this problem. Turning to the next slide, and all of these tables actually are going to be posted online either today or tomorrow, as I'm sort of finalizing this sort of research note. But if you look at the earnings over 10 years of US multinational companies, and again, we're comparing the direct investment income and the subtraction method where we take out the equity income, again, you see a very large difference in terms of what part is in havens. Neither of those series have double counting, but they're sort of putting the income in different places. And I think what may happen when you're subtracting out the equity income is you're not capturing hybrid dividend type income. So for instance, where it might be counted as a deductible expense in the high tax country, but in the low tax country, reported as equity income, that income would get swept out of the low tax country under the subtraction method, but would still show up in the direct investment income. And there's also sort of definitional questions. Are we really measuring where income was earned from an accountant's perspective, or are we more interested in where it was taxed? And I think from profit shifting and a revenue perspective, we're more interested in where it was taxed. So this just sort of shows 10 years of accumulated earnings, just adding them up with those two data series and then comparing that to the IRS country by country data of accumulated earnings. And you see that, there are some remaining puzzles with sort of light haven income with the subtraction method. So I did take some quick squint at the US country by country data and different ways of sort of estimating how much revenue there was. And this is the total revenue that presumably would be shared with other countries too, because when the US earns income in Bermuda, it's not shifting just from the US tax base, but those US companies are also shifting from the German and the French and the other tax bases as well, right? So this is the amount that we would get in revenue to be shared by all the countries of the world that are experiencing the profit shifting under different methodologies. And two things to note from this: one, you get much larger estimates if you look at positive profits only, and the IRS gives us these two different series. But the positive profits is if you sort of go back and look at these columns, for instance, you'll see the positive profit amounts are just much larger than when you sort of aggregate up and include all the companies with losses. Which series to use is a little unclear, but I think maybe one way of thinking about it is it should be some sort of average of these two columns, because we might think the companies that earn profits year after year would be distinct from those who earn losses year after year. But if all companies spend some time earning profits and sometimes earning losses, then we'd want to sort of do something closer to that smaller column. But I also have three different methods here. I'm not going to go through these because I realize we're short on time, but I will be posting this. And there's just sort of different ways of sort of guessing at how much of that extra haven income is really profit shifting and how much of it really belonged in the havens. And so the first row is I think the most inclusive. It's just saying anything that's in a lower tax country is shifting, and that's certainly not the case. The second row, is the least inclusive. It only takes those countries with tax rates less than 10%, and then it assigns to everyone the same profit-employee ratio for those havens. And then the third is my more traditional method, which I've used in a variety of papers, and I replicate here with the country-by-country data. So that's at the end, we end up with about 35% of the U.S. corporate tax base reflected in sort of an average of these numbers. So that I'll leave it at that. But I really enjoyed being part of this conference and all of your insights on how we would think about this problem.
Thanks, Kim. That's really fascinating to see for this one country, the US, where we do have, sources of data to get a comparison of the potential scale. And thank you again for getting up early to do that. Let me hand over to Abdul, who has equally, we should thank for staying up late to to share your thoughts. Abdul, the floor is yours.
Nice to meet you can you hear me? Thank you, Alex. It's nice to see you for the first time and speak to you and everyone here, and for giving me a chance to share some thoughts. I can see that I'm the only speaker here who's not from an OECD country, incidentally. So I'm not sure if Kim was a presenter or a discussant, but I'm going to assume that I'm a discussant. So I'm just going to respond to what has been said by Ruth, Valpy, and David. I don't know if David is here, but or if he's listening. But anyway, so
yes, I am.
Okay. So first of all, I wanted to share that the South Center just finished organizing yesterday a two-day conference where we invited only developing countries to discuss developments in international taxation. And one of the things which we saw is that they're really struggling to understand what's going on, and things are changing so quickly. So in that context, it's useful to have such a discussion on the revenue estimates, because we can have a more substantive discussion on what's going on. One of the things which came up a lot was that there was a demand for a more granular assessment of the G24 proposal, its pros, its cons, how exactly it would affect the revenue, rather than just a theoretical discussion. And Valpy's paper, I think, is the first step in that direction, and I'll be commenting on that in a little more detail. I wanted to commend Valpy and Alex for starting this, actually. The South Center, just to put it out there, from our side as well, we are going to try to help working with developing countries to get them to have their own assessments of how these things are going to affect them, these changes. So commenting on the presentations, they seem to be progressively detailed. So the first presentation was rather vague. It gave a vague formula, and it made some claims, which we are supposed to believe. So not much detail there. So I think that's where my assessment would end, because there's not much to build on. The interesting thing to note is that this idea of a revenue tool, which is being delivered to countries to help them assess what's happening, I wonder why it's not shared publicly. It should be, actually. Anyway, that's up to the OECD to decide to share it publicly or not. But the idea of this tool is interesting. Maybe other organizations can come up with a similar tool and offer that to developing countries. It's always good to have multiple assessments. So that was a good takeaway from that. Coming to the IMF's proposal, it kind of says in a more nuanced way what the OECD is saying, which is that, yeah, it's all fine, all the money will, profit shifting will reduce and so on. But with a little bit more data. What was interesting to see here is that it acknowledges that the choice of factors is important, and employment is particularly important. And, for a developing country, this is a big deal, especially because a lot of the modern production is actually taking place in many developing countries. So to reiterate a theoretical point, which was stated by the G24. If you want to make profit, you have to make something and then sell it. So production and sales are both equally important. So there's really no reason why employment as a factor should be downplayed or not excluded. So it was interesting to see the IMF's paper recognize that. One thing which it missed out was the amount of proposal. It says that once we get rid of the routine profits, then we are going to further get rid of the profits which are due to trade intangibles, capital, risk, etc. A very broad set of terms. Now, I don't know how that's accounted for actually, because a lot of the profit which should be allocated could really shrink there. It would be interesting to have some more assessment on this trade, intangibles, capital, risk, etc. I mean, etc. can have a long set of terms after that actually. So it should be good to discuss that in a little more detail. Yeah, another thing. So in our own conference, one of the participants asked the developing country tax officials, "How many of you have used the profit split method? A show of hands, please." And it was amazing to see that there was no show of hands. So the interesting thing to note is that this is a tool which a lot of developing countries are actually unfamiliar with. So first of all, they're going to have some trouble catching up in figuring it out. And I'm not going to get into how this can be abused within the OECD's proposal to shift profits. So there would be some serious capacity building required in practice, leaving aside the theoretical difficulties. Now coming to Valpi's presentation, yeah, it's a little more realistic. I mean, it includes employment, so in that way, it's a little more realistic. And it makes a very clear point, right, that developing countries will benefit if their big contribution to economic activity is acknowledged. So thank you for stating that clearly. One thought that occurred was that can there be a TPP kind of agreement where the US is removed, so to speak, if it doesn't really want to participate and it can carry on later. I don't know whether the OECD will agree or buckle, or I don't know. But anyway, that was the thought that came up based on what Valpi said. One suggestion for Valpi and Alex as well. So the fourth factor of the G24 formula is users. Maybe that could be included. I mean, not just Alex, like everybody who's watching the conference and participating, who want to help developing countries, maybe we can do some assessment, including users, and see how that would affect the allocation. And yeah, equity and fairness, it's always important to reiterate these principles. These are some comments from my side.
Thanks, Abdul. That's really useful. And yes, as you say, it's unfortunate we haven't got more people in this panel from outside the OECD, but over a range across the conference as a whole. Let me pass over to Laurie, and then what we'll do is we'll gather up the questions from the Q&A, and I will direct them to David and Ruud and Valpi for them to respond along with their responses to your comments, Kim, Abdul, and Laurie. So, Laurie, over to you.
Thank you, Alex. Well, first of all, thank you for the conference and previous great presentations. First of all, I work for the Finnish Ministry of Finance, and I work for the Social Democrats. So we have a five-party coalition government currently in Finland. So the Prime Minister was actually exchanged yesterday, but I do still work for the government at the moment. I'll comment more from the political perspective and less from the technical parts, because I know more about it. So In Finland, we don't actually have our own kind of official estimates yet on the OECD proposals, and I actually don't know if we have used yet the OECD's tool, the jurisdiction-specific rule that David Bradbury mentioned. But I will have to ask that from our ministry. But what we do know that for the Pillar 1, for the unified approach, the impact will probably be very, very small for Finland, since we know some estimates for individual companies. We're not sure if it's negative or positive, but it would be probably somewhere in the range of 0.1% compared to total tax revenue, or 1% compared to the corporate tax revenue. Regarding the Pillar 2, it's probably even more difficult to make the estimates due to the data, since we don't know the profits of Finnish-based MNCs in tax havens, for example. So it's very likely that we cannot make any reliable estimates, but still I find it likely that the impact is bigger compared to Pillar 1, as also David's presentation presented, that the revenue impact of Pillar 2 is higher than Pillar 1. About the political situation, we do not. The current government doesn't actually have an official opinion on the OECD proposals yet, or we don't have either official proposals on the EU common consolidated corporate tax base proposals, or the EU digital tax reform proposals. What are the reasons behind this? Well, there are a few. The first reason is that probably this hasn't been prioritized in the political discussion here. So actually, the discussion in the media and even in academia in Finland, we're a small country, so it has been very, very little, and it's been also quite superficial. So the discussion has been much on the short-term revenue impacts, even in a situation where we really don't know much about them. So, for example, the corporate interest groups have been claiming that Finland will be losing revenues in all of these three reforms, but these claims haven't been really based on credible research, and for politicians, it's very difficult to form a situation in a situation where you don't know about the revenue impacts. So it is very important that the OECD and also the researchers are now trying to make more credible estimates. But also it would be important to get over this kind of situations of talking about the revenue impacts, since in case of Finland, for example, the short-term revenue impacts are very minor compared to the thing that this is perhaps the biggest corporate tax reform in a century. So, and its meaning would be fixing the fundamental problems in the corporate tax system that the previous presentations have discussed. And there are obviously the political parties have also differences them. So in general, you could say that the parties that are closer to corporate interests are more conservative to any proposals. I suppose the case is similar in all countries. And then again, the parties that are closer to the civil society are more progressive about the proposals. But then again, even if you're looking at the short-term interests of only Finland, there are several issues that should be looked into the proposal. For example, the nexus, the selection of nexus, it's important from perspective of small country and also for developing countries, since, for example, very high threshold based on sales might result in a situation that in very few occasions smaller countries could tax the foreign corporations in the Pillar 1. But I think I'll leave it here. So thank you for asking me to comment this.
Thanks, Laurie. It's great to have that perspective, and obviously we can imagine countries all around the world of all different sizes and all different income levels basically going through the same process, thinking, is there enough data to provide a decent answer to the question that I need to answer in order to understand what this proposal means and what position we should take? And I think, we've seen in this session, we have an idea of the sorts of data that are better than others and of the types of analysis that we can do, but it feels that we're still rather far away from having the kind of strong basis to take sharp decisions on this, or perhaps others disagree. We are running rather over time because of my very bad sharing. So what I'm going to do is wrap up some of the questions that we've had from the put forward by people and voted on, and bring them back to each of David and Valpi and Ruud, and ask you to provide just a few minutes of responses to those questions and to what you've heard from Kim and Abdul and Laurie. So if I can find it, if I can turn to David first, and I think you've probably had the most questions raised already, but from the floor, I think there's a few key ones that I should put to you. So perhaps these three. First of all, Kjetil Abildnes from Norway raised this question. You'd mentioned, David, that some countries have shared impact assessments you'd mentioned the assessment tool that countries have had from the OECD. Kjetil says some countries have shared those impact assessments with media or with civil society, but his government in Norway says they can't do this and that this information is confidential according to the OECD. So it's just a question if you can clarify whether governments are actually allowed to share the OECD analysis publicly or not, and if not now, is there a time later they could do, or this just isn't an option? Then Christoph Troutvetter asks how you're modelling the effects of Pillar 2, and are the kind of equivalent simulators as you've presented for Pillar 1. And then lastly, Christian von Haldenwang raises the question of whether tax expenditure, tax incentives shouldn't be factored in rather than just statutory rates. And he noticed that you'd mentioned the issue, but wondered if it was accounted for in the model. So I think those questions and the broader ones raised in the panel perhaps would be great if you can give some sense, David, of your response there.
Great, thanks. Sorry, Alex, I didn't catch the second question. Could you just please repeat that?
Sure, that was from Christoph Troutvetter, just wondering if you have sort of equivalent modelling for Pillar 2 effects to what you've presented for Pillar 1. Okay,
great. Look, I've just made a couple of notes. You might have noticed I'm in a different room. I got kicked out of the room that I was in, so I'm pleased to be able to answer a few of the points. Look, perhaps if I can deal with some of the issues that arose with the discussants as well as the three questions that you've just asked them. Just on the data and the data used, I didn't spend a lot of time, but there is the slide that I had that showed some of the data sources that we are relying upon. And I think one of the unique things that we've tried to do in the analysis has been to bring together a range of different data sources and to try and achieve some sort of alignment between those data sources in what has essentially been a very large profit matrix. Now, the country-by-country reporting data has been commented on. One other data source that I just want to mention is the AMNE database, the Activities of Multinational Enterprises. There are sort of two versions of that database, but they have been an important complement to the work that we've been doing. I should say that when you're trying to determine the residual profit of the global MNE, the data that we have at our disposal is actually quite good because the consolidated data is quite good in terms of Orbis and the other data sets that we're able to draw upon. Where the challenge really comes in is when you're trying to assess the location of the residual profit, which becomes a big driver of the results. And that's where we are forced to rely on affiliate level or subsidiary level data that we look at on a jurisdiction by jurisdiction basis. So just wanted to make that. Just on country by country reporting, the anonymised and aggregated reports, a very large number of countries have now shared that data with us on a confidential basis, but we will be releasing that. The intention is to release that next year. I just want to say this about country by country reporting data, and those that have begun to use the US data that is already made available as you, Alex and Valpi and Kim have done, you will see that it's not the holy grail. It is an important and a significant new additional data source, but I would caution people against building up this data source into something that is like the data source that we've never seen before, the data source of all data sources, because it has some challenges. And the US data shows that, particularly in terms of the relative black box that is stateless entities in the way in which they're defined. There are some issues around potential double counting of intracompany dividends. And there are a range of consistency questions. And so one of the things that we have been doing, working closely with the countries, has been to try and improve the quality of that data. Now, it is going to take years to do that, and we should never lose sight of the fact that the principal purpose of this data was for transfer pricing risk assessment. So it wasn't actually designed in the first place for the use that we are all now trying to put it to. And one of the things we're committed to doing is working with countries to improve the quality of that data over time. So I just want to manage everyone's expectations, because it has been an important part of the data that we have relied upon, but let's not think that it's something that it's not. Now, there are a couple of points about whether or not we have shared the data tool with countries. Now, each data tool is customised per country. And that data has not even at this stage been shared with the other countries, because there are some confidentiality questions, even in terms of some of the underlying data that we've relied upon to build up those estimates, that has been shared with us on a confidential basis from countries. So that is an issue there. Now, if countries are undertaking their own analysis, some of which might be augmented by the work that we're doing, then frankly, it is a matter for them as to whether they wish to put that out into the public domain. But from our perspective, we are not at liberty to do that at this point. We're working to verify, to improve the quality of the available results and data, and we look forward to being able to present more granular results as time goes by, which is something that we think is important, but we're working with the countries to ensure that that's something that can be achieved. In terms of the, are we doing something similar for Pillar 2? Absolutely. That's work in progress. And I think I mentioned that in one of the slides. We will come to that shortly. I just want to mention on the issue of employment as an allocation factor, because this is an important issue, and it's one that I know is close to your heart, comes through in your paper, Alex and Valpi. And in fact, I think one of the points that you also make in that paper that I think is a really valid one is that when we look at the impact of using employment as an allocation factor, we are looking at the world as it is today. And I think we all are pretty certain that there would be multinational behavioural responses if all of a sudden you started making people subject to more tax in the place where their employees were. And I think it is a legitimate concern that you alluded to in your paper around the possibility that firms might manipulate that factor in order to minimise their tax liability. And one of the things that I will say about sales, even though there is no perfect allocation factor here, it does seem to us that when you look at sales versus employment or assets, that it is probably the least susceptible to manipulation. Now, that's not to say that it is immune from manipulation. There are some issues there, but we think that there is a potential, particularly with employment, that you see firms just behavioural responses such as outsourcing, or you might try and capture that. They might start shifting their labour market into low tax jurisdictions. There's all sorts of potential for race to the bottom in other ways that we are not necessarily top of mind when we're thinking just from a tax perspective. Now, in terms of, I hope I've covered most of the issues there. I think that Abdul made a point about traditional transfer pricing profit splits. I just want to make the point that what we are proposing, or what has been proposed under the unified approach, is actually something fundamentally different to a traditional transactional-based profit split. So it is actually really different. And if I could just make a couple of quick observations to conclude about the significance of the reform, because I know Valpi made this point. When, notwithstanding all of the issues around the amounts that might be at stake, and they are important and legitimate questions, and we understand why people want to put a focus on those issues. Firstly, we will only achieve any change if we secure consensus amongst 136 jurisdictions. That imposes its own constraints and limitations. We work within a world. This is not an academic or theoretical exercise. We are now involved in a negotiation of countries of which we are trying to inform that discussion and help get to the best possible public policy outcome. That's the first point. When you look at what the unified approach is actually proposing, firstly, it goes beyond physical presence, a nexus that goes beyond physical presence. Now, that is a significant structural change. In addition to that, we would see for the first time an attempt to assess the liabilities of multinationals based on an overview of the group activities, not just the separate entity approach that has dominated what's occurred in the past. The arm's length principle is a principle that this goes beyond. In addition to that, we are talking about using a formula to allocate additional tax base to market jurisdictions. Now, each of those elements, to many, just a short time ago, would have seemed somewhat heretical, maybe not to many others, but certainly to many of the people sitting around the table engaged in these discussions. But we are having a really serious and genuine discussion that has the potential to make some really dramatic structural changes to the international tax landscape. Now, that's incredibly difficult. I don't want to bore you with the details of how difficult that is, but we are doing the best that we can, and we are working towards a very tight time frame that we hope we can deliver a consensus-based solution by next year.
Thank you, David. And look, we do really appreciate your both your willingness to share what's going on in the evaluation, but also taking time when I know that you are very busy with the steering group and so on. So look, thank you for those responses. We have, I am told, 5 minutes that we're allowed to continue running for, and then we're going to have to get out in order to switch over to the other session. So let me go quickly to Rud and to Valpi. Rud, I think you've heard a few questions raised already, and there were another couple that came through. One asking if you could explain just a little bit more about loss consolidation from George Turner. Shetal Bilsner is asking whether you'd taken natural resource rents out of your estimates and looked at them separately. And then Christoph Troutvetter asking whether if you know where the idea, oh, sorry, that was for a different session. No, so just those two questions, Ruud, along with the points that have been raised by Kim and Abdul and Laurie already.
Okay, thanks, Alex. And thanks a lot for all the comments received by the discussants. I think many of the observations are very well taken and interesting to consider. So let me pick a few of them. I think Kimberly mentioned some of the limitations of the data. In particular, for instance, Orbis data have a number of limitations, because if you look at, for instance, the consolidated accounts of many companies, and what we need is unconsolidated accounts that, if you add up all the unconsolidated accounts in Orbis, the fraction of the total consolidated account is very tiny. For instance, for Apple or Google, very little information is actually present in Orbis on the unconsolidated accounts. So, so we have to find ways of dealing with that. How we dealt with it in our analysis is say, we only include companies for which the total employment observed in the unconsolidated account is 70% of those reported in the consolidated account. So we try to sort of deal with the lack of coverage of some of the companies by saying, well, for those companies where the coverage is really bad, we do not get a reliable picture, so we have to correct for that. And we've tried to do that in the analysis by making some restrictions to the use of the data. But I think these are sort of luxury problems compared to the data issues for the developing countries. Because for developing countries, if we want to do proper analysis, so far we rely on mainly macro data, or in the case of the US, we could use the country-by-country reports. But I think data challenges for the developing countries are way bigger, and I think it would be very good to think of ways to find alternative avenues to get more reliable data for those countries. But I think many of the issues are very well taken. Abdul, I think, made a couple of very interesting observations. One was a question on these residual profits and how we can sort of think better about what is the origin of these excess profits. Where do they come from? But I think the attraction of the ideas of formula apportionment and also of residual profit allocation is to say, well, we don't know where the profit of a multinational really come from. We don't know how to attribute this to marketing intangibles or to synergies or to R&D. It is basically impossible to allocate each of the profit to each of those activities. And the attraction of the residual profit split is to say, well, where we do know where to sort of allocate profit to observable factors like assets or sales, we do it. That's the routine part. But all the rest is the residual, and we allocate that based on some formula. And I think that takes away all these difficulties and all these arbitrariness in using arm's length pricing to try and allocate it to certain activities. So I think it's basically dealing with sort of the inability to do it in a way that is quite transparent so maybe that's the point on the. Then maybe Alex's comments on on loss consolidation. Maybe a few more words then. So basically, what happens now is that each subsidiary can carry forward its losses, and it cannot use losses to offset it against profits in another affiliate. So all the losses accumulate, build up sort of loss carry forwards, and they can be used possibly in the future to be offset against future profits. Now this creates a huge pile of losses that are unutilized. But if you consolidate the accounts and you say, well, the losses in one affiliate can be offset against the profits in another affiliate, you no longer have to carry those forward, but you can immediately use those losses. So that's, of course, a big advantage, and that's also what multinationals see as a big advantage of formula apportionment, because many multinationals are actually not against formula apportionment. They say, well, the loss consolidation part is very good for them because they can immediately use their losses in one affiliate against profits elsewhere. So this is a reduction in their tax liability, but of course then a reduction in the tax base for countries. And so what was interesting of utilizing these micro data set is that you can sort of put a number on how big this is. And the 10% that we find is quite a significant number, because there are a large number of companies or affiliates that actually make losses. So maybe I'll stop there on the loss consolidation. Then on resource rents separately, well, this would be possible, but this requires even more granular data then, right? To have sort of information about these sectors. If you use micro data sets, you can do that. But for the other data sets where we have sort of aggregate data, that's impossible. But I think it's interesting exercise to look more at different sectors. For instance, also look at the extractives, look at the banking sector and how you would like to apportion profits of banks, because it's probably not based on fixed assets. Fixed asset of a bank is almost nothing. Their assets is something else. So you need to adjust the formulas. And I think this sectoral analysis is really an interesting next step for the analysis of formula apportionment.
Cool. Thanks, Ruud. That's really great. I'm afraid, very unkindly, I'm going to give Valpi about 1 minute to respond to the last point. I think Valpi Abdul had raised the question of including users in the data, but you may also want to respond to some of the other points around data and perhaps the other discussion that we've heard. And then I'd better close this very quickly before I get told off.
I will do this as quickly as I can. Thanks to everybody for the very useful comments. On users, the problem is that we have no data on users to apply. So unless Google or someone will supply us with all this data, we can't actually include it at the moment. Running through the main comments from Ruud, very interestingly, his treatment of losses is extremely interesting, but as I'm sure he's aware, the losses themselves are accounting conventions and can be precisely created by profit shifting, and in consequence, one would take great care in using them without allowing for the fact they're an artificial construct. I also agree strongly with his point that there is no way of actually technically allocating profits to jurisdictions. So we have to agree on a formula. An agreement means it's negotiated, not a technical fix. On Kimberly's remarks about the fragility of the data, I agree entirely, but we must remember that in trade negotiations, you have exactly the same problem, but the UNCTAD and the WTO between them do produce direction of trade data and data for all sorts of different commodities on which everybody has public data which they can use for trade negotiations. Last on David, on particularly his warning about not taking employment as a factor because it could be result in a shift of employment away from high tax jurisdictions. But my first point is that this would require an investment shift, and we know actually that the investment elasticity, the real investment elasticity to taxation is lower than financial effect, and we also expect that under the new rules with alternative minimum taxes and so on, the amount of shifting is going to be much, much less. So I think the employment effect will be less than he suggests. I also feel that taking sales as being some fixed and objective thing which can't be shifted is also an illusion. If we take the specific case of Google, Google does not sell anything to you or I. It makes its money from advertisers, and the advertisers can be located anywhere and relocated anywhere. So the final sales of Google can all be very simply relocated to Luxembourg if they need to. Thank you.
Thank you, Valpi, both for the clarity of that and for being brief. Much appreciated. Let me thank all six of you. That's a really fascinating discussion. I feel like there's some consensus around the importance of employment when we're looking at apportionment, and some consensus around the questionability or the need for caution and for better data. But a lot of differences in opinions and results on other issues, and that's only a lot of focus on uncertainty and complexity, some of which we will turn to in the more policy and political discussion in the next panel. We will start the next panel in 15 minutes, and that's 5 minutes later than scheduled, just to let everyone have a break. But for now, thank you to all our panelists and to everyone who provided questions on the floor. A really great and high quality discussion, which I'm sure will be continued over the months and indeed years to come.